Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Group. It is so nice to see everyone. I'm so happy that you all were able to make it today. And we have a really great presentation that we're going to talk about. I'm going to show the basics of multifamily, the basics of apartment complex investing. And by the end of this presentation, you're going to come away with some things that you may not be aware of and you may not have seen before. And it is something that so many investors, they spend years and years in the forest, lost, looking around, being what I call the small-time landlord. The small-time landlord, he buys 5 or 10 houses and he's spending all his time and he thinks he's getting ahead of the game. Don't be that small-time landlord. You need to come on over to the multifamily side because this is cash flow on steroids and it's so much better. Unless you're doing it as a hobby, buying a lot of single-family homes is not the best use of energy. So let's go through this. Okay, so first of all, let's talk about real estate in general. Real estate is an ideal investment. And what that means is it offers a few benefits that include income. You get income off of the real estate, rental income. And it's a beautiful thing because every year you can raise the rent on your tenants because you have to keep track of inflation and taxes, and you've got to account for that within rent increase. It also offers depreciation if you're a high earner that's like a dentist or a doctor, or maybe you're a CEO, or maybe you're some sort of a business person and you've got a lot of potential taxable income. You can soak up a lot of that taxable income by depreciation, the magic of depreciation. Equity growth. As you pay down over time, over the years, the mortgage, you are building up more and more equity because typically on most mortgages, there's a bit of principal that is included in that payment. So that's important. Then, of course, you've got the magic of appreciation. That's where you just hold on to an asset, and as time passes and inflation works and all the things go on, and as the supply and demand of people moving into the area, people are always making more people, and there's a shortage of land, and it forces appreciation. And then the real beautiful one is leverage. Leverage is such a wonderful thing because by using high leverage, you can sometimes get a high IRR, an internal rate of return. So it is so exciting. Multifamily is better than single family rental homes. It provides more cash flow and is easier to manage. Now, folks, I'm not giving you a hard time if you buy single family homes. I still buy single family homes. I've done it for years. It's kind of a bad habit. You just get into a habit, you see a house, you buy a house, and then you do it over the years, one house after another, and you think you're getting ahead and you buy 20, 30, 50 of them or whatever. And then you wake up and you realize, heck, I thought this was cool. No, that's not cool. What's cool is going and buying a 100 unit, a 200 unit apartment community. That's cool. But there's no harm in buying single family homes. I just want you to be aware that it may not be the smartest move. Okay, so let's talk about one key thing. And this is going to be real important in some other slides. Now, some of you already know all about this, but just keep your ears open, please, because on the next few slides, I'm going to show you some things that you may not be thinking about. So cap rate is used in multifamily investing. It is a metric to determine how some things are priced. So for example, if you have, let's take an example here of a multifamily property, a little tiny multifamily. Let's pretend it's got 10 units. It's just a little baby multifamily property, 10 units priced at $1 million. And let's say that the rental income from your wonderful tenants is generating $80,000. Say that the annual net operating income, not the rental income, the net operating income is 80,000. So you subtract it, you've gotten more rent, you've gotten a lot more rent than 80,000. But after you subtract your expenses, you have 80,000. You have 80,000 in net operating income. You know, you've subtracted the taxes, you've subtracted the insurance that you have to pay. You've subtracted everything, but you're not including debt. So don't subtract any debt. It's not part of the calculation. So with this, you would calculate what's called a cap rate. let's say that the net operating income's 80,000, you're going to divide it by a purchase price of maybe you paid $1 million for the asset. That would give a cap rate of 8%. So in this example, the cap rate would be 8%. Now, when people first hear about cap rate, they think, well, I want more income, so I'm going to go get a high cap rate. That's the first thing that goes off in their mind is, I would rather have an 8% cap rate because I could get 80,000 instead of a 6% cap rate because I'm only going to get 60,000. Well, folks, there's a lot of things that are wrong with chasing high cap rates. I'm not going to go through the entire thing here in this presentation, but I want you to be aware that you shouldn't buy investments based on them being a high cap rate because you're actually moving into a more dangerous investment class if you buy higher cap rates. For example, you could buy a package of homes in the ghetto. Maybe you buy a package of 20 or 30 homes in the ghetto. The cap rate on that in a dangerous area where it's dangerous to collect the rent, where you know, that could have a 15% cap rate, but I wouldn't recommend it as an investment. Just be aware of that. Be aware of that. But I've got some other presentations that I talk about it in more detail. Okay, now let's talk about the multifamily market. I've picked the United States, you know, at some point should include Germany, should include Poland, because Poland is such an important market for multifamily. But at any rate, here we've got some different cap rates. So in the Midwest, this is data that's recent. And if we look at the fourth quarter in the Midwest, cap rates were 5.65, you know, far right column, first row, 5.65. So what that means is 56,500 in net operating income on $1 million asset. Now, if you went to say, let's look at the Southeast, go down on Q4 to the Southeast, 4.45. So the net operating income is, the cap rate is lower there. So that's what we're dealing with. That's what cap rates look like right now in the United States for multifamily assets across the United States. So the national average cap rate's about 4.59. So if you were to spend $1 million on multifamily real estate in the United States, you could expect to get approximately $45,900 in net operating income. Okay, so now let's take a look at something that makes apartment investing so special. This is what really is the icing on the cake with apartment investing. So I'm going to break this down because some of you understand it already and some of you are new to this game. So let's go through some things here. We're going to do a comparison of what happens with a $100 rent increase. So imagine that you've got some tenants and one of your tenants is in a single family home. Maybe you bought that single family home and you've got a tenant in there and every month he pays rent right on time. He's a good tenant. And say it's a nice single family home. It's priced at about $200,000, for example. And then you also own a small multifamily unit that is 10 units, and you've got 10 units in there and they're paying rent and each of them are in their unit and you're getting rent there. And then imagine that you also have a really big multifamily that you bought. You've got 100 units. You took down an elephant. You took down a big multifamily. So with this, imagine for purposes of comparison, to make it crystal clear, that you're getting a 5% cap rate on each of these different assets. Okay. Now I want to explain. Single family homes, you don't use cap rates with single family homes. That's used in the commercial world. Single family homes, the valuation is different. It is done with what's called a comparable sales approach. So the value of a single family home is determined by the value of what other single family homes are selling for. But that is not the case with multifamily. With multifamily, it is a totally different situation. Multifamily uses cap rates, but in this example, I'm showing it this way so that you can more clearly see what happens. Okay, so you go to your tenant in your single family home and you say, hey, listen, or more realistically, you have your property manager do this, but imagine you're doing it yourself. You say, look, you know, I've got to raise your rent $100 a month. I don't want to do it. You've been a good tenant, but I've got to raise your rent $100 a month or you got to move. And the tenant says, okay, I'll pay. So now you have managed to, on your one unit, you got that tenant to agree to pay $100 a month. So you get back in your vehicle and you drive away and yeah, I got $100 a month. Great. And you're thinking to yourself, that's good. That's good. I'm going to get $1,200 more a year. And you're driving back to your place and you're thinking, okay, $1,200 a year. That's great. Then you drive over to your small multifamily because you're on a roll. And you show up at that small multifamily with 10 units and you bang on the first, you ring the doorbell politely. You ring the doorbell politely and you meet with each of the tenants and you explain, I'm going to have to raise your rent $100 a month or you're going to have to move. And every single one of them says, well, you know, you've been a good landlord. We understand. Let's just pretend this happened. Okay. So you get all 10 that do it. So you get back in your car, you're driving and you're thinking to yourself, yeah, that's great. That is great. So I've got 10 units and I'm getting $100 on each unit. I'm getting $1,000 a month. I'm getting $12,000 a year in additional rent. You're feeling really good. And then you say, you know what, I'm going to go do the same with my big multifamily. So you take 2 or 3 days and you go, you would really do this all with property managers, but you get $100 on those multifamilies. So now you're collecting on your 100 units, you're collecting $10,000 a month or $120,000 a year in additional rent. And now we're going to see the magic. Now the moment of magic. So because of the fact that the cap rate is 5%, you'd think, okay, how much has my home gone up in value? So you call up your appraiser and you say, hey, I got something really good that happened. I raised the rent $100 on my single family home. How much is the house worth now? Is it worth more than $200,000 because the tenant's paying more? And the appraiser says, no, the house is worth the same because look, it's still the same comparable sales. I mean, whether you charge the tenant $100 or $200 a month more, it doesn't make any difference. So you say, okay, I understand. Well, what about on my 10 units? I raised the rent $100 on my 10 units. What does that do? And the appraiser says, well, you know, because you raised the rent $100 on your 10 units, you're getting $12,000 more rent and all of your expense profile stayed the same. So your net, that goes directly to your net operating income. So now you get to see the first magic of that $100 rent increase. Because you raised the rents $12,000 a year, now you're going to divide by the cap rate. And the cap rate in that market, it's a market that's a hot market, that's attractive. It's just like the national average I showed you is 0.05. You take 12,000, the increase in your net operating income, and you divide it by 0.05. The value of your asset just increased $240,000. Think about that. You went and you talked 10 tenants into signing a new lease for $100 more per month. And that raised the value $240,000. And when you go to a 100-unit property and you raise the rent $100 a month, you raise the value not $240,000, you raise the value $2.4 million. So that is what is so important about this to understand. And that's one of the powerful things about multifamily. So now that we've covered that, let's go through this. So let's talk about the number one mistake that new real estate investors make. The number one mistake that they do is they buy the wrong asset class. And what I mean by that is, seems like everybody that's a real estate investor, they go around to these clubs and they say, hey, you know, I want to be an investor. Oh, let's go buy some houses. Well, I mean, I understand. Buying a house is not hard to do if you're a real estate investor. The houses are essentially free if you know how to structure the transactions. So buying a house is not hard to do. And that's one of the problems is people get into a habit where they start buying 1, 2, 3 houses a year. And then they do that for 10 or 20 years, and they end up with a small, insignificant collection of houses. They may have 10 or 20 houses, a small and insignificant collection. but it may take them many years to do that. Whereas if they had the knowledge, they could learn how to do multifamily, or if they don't have the time and they don't have the energy, they could work with someone like Benjamin Z. Miller, and I could help them get into the best deals. But at any rate, this is the number one mistake that is there. In 90 days, if you have the knowledge, you could acquire a 50, 100 unit multifamily. Now, I'm not saying that as a completely new investor, maybe with no connections and no knowledge, that would be easy to do. But if you have the knowledge, if you have the training, it is very feasible to do that, especially if you've got the network. So that is something that's so important. What are the benefits of apartment investing? Well, once again, it is cash flow on steroids. You know, people talk about bodybuilding and how you can use steroids. Well, apartment investing is cash flow on steroids, because you're not getting one little rent check from one little tenant. You're getting 100 rent checks from 100 of your tenants. And that's an exciting thing. It also is far easier to manage because you don't have to manage it. If you're a good real estate investor, you don't manage any of your own things directly. The reason you don't manage any of your own things directly is it's a waste of your time. Your time should be spent looking for motivated sellers, and your time should be spent negotiating deals. Your time should not be spent on the telephone listening to a tenant talk about how, you know, the water, the sink is leaking, or how the toilet's not working. That is the job of a property manager. So you will bring in a property manager, but you will be the asset manager. So you can be the asset manager, and you will hire a property manager, and that's the best way to do it. So you're going to manage the asset, and then you're going to have a property manager manage the collect the rents and do all of that, but you're not going to actually talk to the tenants. So what is the second mistake that new real estate investors make? The second mistake is maybe they're aware of multifamily, but they have this idea that I can't do that. I don't have enough money to do that. So instead, they will go invest 25 or 50 or 100,000 buying a little house or a duplex. God help us if anybody buys a duplex. No offense, everybody's bought duplexes, but I mean, this is something that is the second mistake that investors make. They end up actually not being aware that they can invest in these deals. And I'll tell you why they're not aware of it. I'll tell you the reason. It's because most good multifamily investors, they don't need a bunch of limited partners. They already have their circle of friends. You know, birds of the same feather, they flock together. And so they've already got their group. They've already got guys that for years they've been doing deals with. So they're not if they're a good multifamily investor, they're not spending a lot of time trying to find investors because they've got investors wanting in on their syndicate. So that's the only tricky part, is to find a general partner that will allow you to invest into their syndicate. And I have a few pieces of advice on that will help you if you are interested in that sort of thing. The first piece of advice is if you need help with something like that, just ask me. I know so many apartment investors in the business. I also am an apartment investor, but I do more than just apartments. I do a lot of different things, but I can help you with that if you need an introduction. Now, we should get to know each other first, get to understand everything. But when the time is right, after there's a business relationship, sure, I can introduce you, I can show you deals, and then you can participate in these without having to go through the process of becoming a general partner. Because learning about apartment investing, it takes a commitment. Just like if you're going to be a doctor or a dentist or other professional, you have your area of expertise. But with this, what's great about apartment, what's great about multifamily is, frankly, the limited partners often end up doing better than the general partners. And I'll talk about why that is. But you can get into these deals sometimes with as little as 25,000, 50,000, 100,000. Probably normal's 50 or 100,000. So how much do they cost? Well, the prices are all over the place. I mean, you could get You could get a small multifamily for small baby multifamily that's 10 units. You could find that in some parts of the US for 500,000, 600,000. Or if you're talking about larger sized apartment communities, they can range millions of dollars. You know, it just kind of varies. Here's one that's in Temple, Texas, 25 million. It's got 89 units. Here's one that's in Houston, Texas. It's 11 million and it's got 97 units. And you notice how they show the cap rate right there. That is telling you that if you purchase that based on what they call the T12, the last 12 months of performance, you're going to get 6.22% times 11 million. So you can get a significant amount of net operating income off of that one, you know, and that's an interesting one. So let's talk about classes. Now, you know, this is something where there's classes in society. Well, there's also classes in multifamily, and let me introduce you to them. So Class A multifamily, these are the really premium assets. And these assets, you don't, frankly, as an investor, want to buy, and I'll tell you why. It's because you won't make as much money on a Class A as a Class B or a Class C. But first, let's start with what is a Class A. So a Class A is a very new building. A Class A is something that's it's something that would be maybe a product that's a brand new building right in the center of town, a beautiful property. And the thing about these beautiful properties is they're expensive. And the other thing about them is the cap rate that they sell for is very low. So we know the national average cap rate might be 5%. A Class A could have a cap rate that's 2%, 3%, 3.5%, somewhere in there. So the cap rate is lower on a Class A, and that's because you've got higher quality tenants, you've got less repairs, you've got a lot of things in your favor. But who these Class A assets appeal to is they don't appeal to individual investors very often. They're attractive to insurance companies. You know, when you write your check for your insurance, do you know what those guys do with that money? They put it in a Class A property a lot of times. So when you're making all your insurance payments, that money is migrating over into a Class A property. Now, I'm not saying that's the only thing. Insurance companies invest in a lot of stuff, but the insurance company, they are content with some ridiculously low rate of return, like 2% or 3% or 4%. I mean, for example, who would want that sort of a return? Wouldn't you rather have 10%? Wouldn't you rather have 12%? I think so, folks. I think so. But if you ever get to the point where you have accumulated so much money that your concern shifts to, I just want to put it someplace where it's totally safe, a Class A property is good. Class B is a little bit older. Class C is now you're getting into old stuff. And there's a saying in multifamily investing that you should buy a Class C property in a Class B neighborhood. Now, what that means is if you have a choice, you would ideally like to find a Class C property, one that's old, a little bit rough, beat up, but still producing income, that happens to be in a Class B neighborhood so that you can do value add where you can improve it, make it better. And then now when you refinance it, it will get a very good appraisal. So that is something that's important. And then there's, of course, Class D. And you definitely don't want those, folks. You don't want those. Those are something that are that's the vulture investing world. And it's not something that I recommend. So how is multifamily apartment complex purchased? Well, it's a process where you've got a general partner. Now, the general partner is the guy that knows what he's doing. The one that has a good general partner should already own over 1,000 units. So if they don't own 1,000 units, you should think about that. If the group that put the deal together does not already own 1,000 units, I wouldn't rush to invest with them. You know, so if you get approached by a general partner and they don't already own 1,000 units, or their group does not already own 1,000 units, you should let somebody else gamble on a new investor. It's better for you, if you value safety, to go with experience. And experience means 10 years. It doesn't mean that they've been playing around for 1 or 2 years and they took a few courses on it. It means 10 years of experience. Ideally, they should work in the industry. or, they've got a track record of success. If you do that, you will avoid 99% of the problems. The problems that people have are when they got a new multifamily investor and they start investing with them, and they don't know what they're doing. And the limited partners, it's the blind leading the blind. We have a saying, the blind leading the blind. So that's why you want to steer clear of that. You want to focus on experienced general partners. And what will happen is the general partner, he'll go and negotiate the deal. He'll talk to the seller's agent. He'll sometimes talk to the seller directly, work out a purchase price, make an offer, get a contract signed, put it under contract. Then the general partner will also arrange the financing. That is also his job. He's got to arrange the financing, where he's got to go to banks, talk to them and say, here's the asset, I need a loan. I'm putting together this deal, or he's got to work something out. He's got to arrange that. But let's say it's a $10 million asset. The general partner will put a contract on it. There'll be a $7 million loan that is worked out. And then what will happen is there is $3 million that is needed to close the deal. Now, it's not always exactly $3 million, but I'm making the numbers simple here to explain it. So that $3 million, that will be obtained by the general partner reaching out to his friends and his business contacts, and sometimes people that he doesn't know all that well. But most of these guys that are doing this, they're working with the same people over and over and over again for years. So that's why when you get in with a general partner, you want to keep that relationship going, because once you've tapped into that deal pipeline, you can every year make another investment. So, but then they will syndicate it. And during the syndication process, you will get ownership. And then basically you're going to wait 3 to 5 years and your money will get doubled. Now, it doesn't always work out exactly 3 to 5 years, but in the hands of a good multifamily investor, that's very feasible. Worst case scenario, maybe 6 or 7, but 3 to 5 is kind of what they're shooting for. That's what they like to see, to be able to double money for people in 3 to 5 years. So that is the basics of it. Now, there's another thing that I will mention that sometimes comes into play. There's also what's called mezzanine financing. This is sometimes used in multifamily. What will happen is the general partner will get a deal, get it under contract. He has to raise $3 million. He gets on the phone, he calls all his friends, he calls and he gets, he's only got 1.8 million raised and he's running out of time. He's only got a few days. He may only have 30 days, 40 days left before he has to do this. And he's going to lose the entire deal and the earnest money that he gambled if he doesn't put it together. So in that case, sometimes they'll bring in a mezzanine financer. And those are basically just kind of like the loan sharks of the world. I mean, what they do is they technically are not in a first lien position. They're supplying down payment money, but they come in on they're in the partnership agreement, the company agreement. But what they do is they basically set it up where they say, okay, look, you're going to pay me on that million that I'm going to loan you. I want to get a 12% rate of interest. And I also want to get some equity, but you can pay me off and all this. So that's basically something that from time to time is running around. How do you double your money? Well, the easiest way is you don't invest on your own. If you want to make it hard, go do it by yourself. That's the hardest way, because you start out not knowing everything about the game. You're trying to learn while you're doing it. It's much better to invest with a group. There is strength in numbers. There is power in numbers. And that's one of the great things about the Benjamin Z. Miller Investor Networking Group is here. We've got a powerful group that can help you achieve your investing goals. So don't be the general partner on your first few deals. If you want to be a general partner, if you've got a burning in your heart where you think, I really want to do that. I really want notes over everything that's wrong with them. And then I want to negotiate with the guy and I want to run around and arrange financing. You can do that, but not on the first few. Get proper training. We can help with that training if you're looking for that training. But you want to only invest with general partners that have a long history of success. Try and avoid general partners where it is their first deal. That is so, so important. Okay, and the other thing is apartment investing is a team sport. And let's talk about the people that are on the team. Well, you have the general partner, that's the experienced guy. You've got the property management company. That is the company that will actually do the day-to-day management, where they're going to say, hey, you told us you were going to pay the rent and you paid late. You got a late fee. Listen, if you don't pay us, we're going to evict you. That's what the property management company does for you. You've got the limited partners. These are the doctors and the dentists and the ones that have extra money that, you know, they're working. They don't have time to play around with this, but they like the idea of doubling the money, you know. Then you've got the lender. They are out there, and they always are out there. They're a dime a dozen finding one that will make a loan at 70% of the value. So working with great people is the way to get great results. And that basically is just so important. How can you find a deal? If you need help with that, just let me know. And I'll email a copy of the slide deck. Since we're short on time, I'm not going to play this, but you can watch the video later. Also, if you know anyone that's a burned out landlord, maybe one of your friends or family, they've got a collection of 10 or 20 or 30 houses or 5 houses, whatever they've got. And they're like, I don't want to do this anymore. I have a solution. If your friend or family member, or maybe you are in that situation, I can get you out of all of those, where I can trade you, where I'll take those and then I'll put you in a one or more multifamily deals. So it is exciting, where then you get, and we do it correctly. It's a fair deal. We figure out what it's really worth. We determine how much cash you want to get out of it. I make it fair. That's my specialty. And then you get your cash, you get away from all those headaches. You can just get rid of them. And instead you can get that passive mailbox money and just be a limited partner in one or more. So that's my landlord rescue program. So if you know a landlord that is just burned out, where they've had enough, they don't want any more conversations about the tenant and the you know, what's wrong with the toilet, let me know. I can help with that. So the take-home message is, don't lose out on the power of multifamily. So critical. I also have a YouTube channel where you can watch some more videos on it. One more announcement. Every Thursday, I offer passive income webinars. These are fantastic. If you're the type of person that likes passive income and mailbox money, you will love these. I will get you if you fill out the registration sheet in the chat window with your email address, I will make sure and email you these links so that you've got so that you can go to these and you can learn about 2 wonderful companies. Alamo Mortgage Holdings is a company that purchases mortgage debt in the state of Texas, and Andesite Blue is a company that is going to help rebuild Ukraine, the reconstruction of Ukraine. Another couple of reminders: if you have any friends or colleagues that you think might benefit, please invite them to come to these meetings. Come one, come all. Come to the Benjamin Z. Miller Investor Networking Group. I love it when we get new people that come to the group and we can help them out. It makes the group stronger. It makes everything better for everyone. So invite your friends and family. We share the link with you, and you can share it with other people that you think are good people. Okay, very good, very good. And last thing, I do have a mentoring program. If you want to learn from Benjamin Z. Miller, you just let me know. I love to help people, and you know, I work really hard on that, and I can show you things that a lot of those gurus that are out there, they don't even know about. I know some things that a lot of other people aren't doing. So it's pretty interesting. And that is it for the presentation. I'm going to stop the recording, and then I'm going to open it up for any questions.